There was one trade I still remember very clearly. Not because I made a huge profit, but because I refused to accept a small loss. I had bought an option after what looked like a perfect setup. The market started moving against me. My option premium fell by 10%. I looked at the screen and thought, it's okay, it will come back. Then it fell another 10%. I still didn't exit. I told myself, I know this market, just give it some time. Then came the moment I still remember. The premium was down almost 40%. And suddenly, my small loss had become a serious loss. I was no longer following my trading plan. I was simply waiting for the market to prove me right. That day I learned something painful. A stop loss is not designed to protect you from being wrong. It's designed to protect you when your original trade idea is wrong. And after that trade, I completely changed the way I looked at stop losses. Here's what I learned. Most beginners do something very simple. They buy an option at 100 rupees and decide, if it reaches 90 rupees, I'll exit. That sounds logical, but there's a problem. Why 90 rupees? Why not 92 rupees? Why not 85 rupees? What does that number actually mean? A stop loss should ideally be connected to the reason you entered the trade. For example, imagine Nifty is trading around 24,850. You see a bullish setup because the index has broken above an important resistance level. You buy a call option. Now imagine the underlying index falls back below the level that made your bullish setup valid. Your original idea has changed. That is much more meaningful than simply saying, my option is down 10%. Because option premiums can move for many reasons. The underlying can move, volatility can change, time decay can affect the premium, and liquidity can affect your actual exit price. So I started asking myself one question before entering every trade. At what point is my trading idea no longer valid? That became my real stop loss. But there is another important part. Position sizing. Suppose you have 50,000 rupees of trading capital. You decide that you are willing to risk only 1% on one trade. That's 500 rupees. Now imagine your planned stop loss means you could lose 10 rupees per option unit. Your position size should be calculated around that 500 rupees risk. Not, how many lots can I afford? That was another mistake I used to make. I used to think, I have enough money for 2 lots, so I'll take 2 lots. Now I think differently. First decide the risk, then decide the position size. And there's another dangerous habit I had. Averaging down. My option would fall. I'd buy more. It would fall again. I'd buy more. I thought my average price was becoming better. But my risk was becoming bigger. I wasn't fixing the trade. I was simply adding money to a losing idea. Today, if my original setup becomes invalid, I exit. I don't argue with the chart. I don't revenge trade. And I definitely don't increase my position just because I'm losing. There's one more thing I want you to remember. A stop loss doesn't guarantee that you'll always exit at exactly the price you planned. During fast markets, gaps, or low liquidity, the actual execution price can be different. That's why risk management isn't just about placing a stop loss. It's also about keeping the position size small enough that an unexpected move doesn't destroy your account. And this is probably the biggest lesson I learned. You don't need to be right on every trade. You need to survive the trades where you're wrong. Because one big loss can erase many small profits. I once believed that a good trader was someone who could predict the market correctly. Now I believe something completely different. A good trader is someone who knows when to stay, when to exit, and most importantly, how much they can afford to lose before they even enter. That one trade taught me something I wish I'd understood much earlier. The most dangerous sentence in trading is, I'll wait. It will come back. Sometimes, it doesn't. This is part 7.